Have you noticed how every time there's tension in the Middle East, people start asking the same question? Should I buy gold right now? It feels almost automatic. War headlines hit, fear rises, and suddenly gold is everywhere in the conversation. But here's the truth. Most people miss gold doesn't move the way people expect. Sometimes it spikes, sometimes it drops, and sometimes it does both. So today, let's break this down clearly using real historical patterns, what current Iran war data is actually telling us right now. If you want to understand how money reacts to real-world events like this and makes smarter decisions instead of emotional ones, consider subscribing to Wealtiny, liking the video, and turning on the notification bell so you don't miss insights like this. Let's start with what history says. Gold has a long reputation as a safe haven asset. During times of war or crisis, investors often move money into gold because it holds value better than many other assets. And historically, this pattern shows up again and again. During the Gulf War in
1990 to 1991,
gold rose roughly 10 to 15% in the early phase of the conflict. During the Iraq War in 2003, gold gained around 15 to 19% over the year as uncertainty increased. More recently, during the 2023 to 2024 Gaza and Middle East tensions, gold spiked, quickly jumping about 8% in just a couple of weeks as fear entered the market. Pattern interrupt. Notice something? Gold doesn't just move randomly. It reacts fast to fear. But here's where it gets interesting and where most people get it wrong. Gold doesn't always keep going up. In many cases, gold spikes at the beginning of a conflict, and then either slows down or even drops, even while the war is still ongoing. And that's exactly what we're seeing right now. Recent data from the current Iran-related conflict in 2026 shows something surprising. Instead of continuing to rise, gold has actually dropped sharply by as much as 9.5% in a single week, marking one of its biggest declines in over a decade. Another report shows gold falling around 4.9% shortly after the conflict escalation. Despite rising geopolitical tension, pattern interrupt. Wait, war is happening. Fear is high, so why is gold falling? Here's the key insight. Gold reacts not just to war, but to the financial environment around the war. Three major forces are affecting gold. First is the strong US dollar. When the dollar rises, gold becomes more expensive globally, which reduces demand. Second is higher interest rates. Gold doesn't pay interest, so when rates go up, investors often move money into assets that do. Third is profit-taking. When gold has already gone up significantly before a crisis, investors sometimes sell during the chaos to lock in gains. Pattern interrupt. So the real pattern isn't war equals gold up. It's fear spikes gold, but macroeconomics decides what happens next. Now, let's bring this back to your question. Should you buy gold right now? The honest answer is, it depends on your strategy, not the headlines. If you're buying gold expecting a quick spike just because there's conflict, history shows that move may already be late. Gold often rises before or immediately at the start of conflict, not after everyone is talking about it. But if your goal is long-term protection, gold still plays a role. Gold has historically helped preserve purchasing power during inflation, currency instability, and global uncertainty. It's often used as a hedge, not a fast profit trade. Pattern interrupt. Think of gold less like a rocket and more like a shield. Another important point is diversification. Financial guidelines, including those referenced by the U.S. Securities and Exchange Commission, suggest that spreading investments across different asset types can reduce risk. Gold is often one part of that mix, not the whole strategy. So instead of asking, should I go all in on gold? A better question is, how does gold fit into my overall financial plan? Now, imagine this scenario. One person buys gold emotionally after seeing headlines. Another person already has a small allocation to gold as part of a balanced portfolio. When volatility hits, who's more stable? The second person didn't react. They were already prepared. Pattern interrupt. Wealth isn't built by reacting fast to news, it's built by preparing before the news hits. Here's the key takeaway. Gold does tend to spike during major conflicts, but those spikes are often short-term and influenced by bigger forces, like interest rates, inflation, and the strength of the dollar. Right now, the data shows that even during active conflict, gold can fall if those larger forces push against it. So buying gold purely because of war headlines can be risky if you don't understand the timing and the bigger picture. A smarter approach is to treat gold as part of a long-term strategy, something that protects wealth. It's not something you rely on for quick gains. So here's a question to think about today. Are you reacting to headlines? Or building a strategy that works no matter what happens next? If you want to keep learning how real-world events affect your money and how to position yourself smarter, subscribe to Wealtiny, like the video, and turn on the notification bell. Because in the end, it's not about predicting the next spike. It's about understanding the pattern and using it to your advantage.